already in construction, already, on your way before the One Big Beautiful Bill was passed, you're unaffected by all these changes. Once you start to get to July 2026, things start to change. So if you're a solar or a wind project in particular, if you start construction before July of 2026 and you're actually placed in service by the end of 2027, you should still receive full credit. That's very difficult, I think, to do, depending on how far along a project is. Um, After July of 2026, you can still start construction, but you have to be in service by 2030, sometimes 2029, depending if it was 2025. Other technologies like storage, geothermal, nuclear, these all have a much longer runway and they still continue to get tax credits. So it's really impactful for solar and wind projects, but less, on the tax credit side for some of these other technologies. However, a new piece was also introduced in the One Big Beautiful Bill called this Foreign Entity of Concern, or FEOC as we call it. This applies to all technologies. And this means any foreign influenced, any ownership, any effective control by a foreign influenced entity. And it's typically, a handful of countries, China, I can't even think, Russia off the top, North Korea, Iran, I think is on there. These are typically the entities that you're thinking of. However, understanding where your supply is coming from, how the ownership of a company that is your supplier has changed over time, all of this now starts to matter. And this is for all technologies. And the intention of this is to begin in January of 2026, so within a handful of months. And we are still awaiting guidance to ensure that everybody understands exactly how this works. That guidance was supposed to be released at the end of this year, sometime in the fall. As I understand it, it may not come out until next spring. And again, this goes into effect in January of 2026. What happens here is there's also material assistance cost ratios by technology and year. So you are still allowed to have some component that might fall into this area. But there has to be there's a defined percentage, and that defined percentage changes over a year. And I added this piece on here. This introduces additional what's called recapture risk. So when you're doing a tax equity deal, if it used to be within 5 years, if there was something that happened to the project and you ended up losing the tax credits associated with that, it took place within a 5-year time frame. This extends that to 10 years. So that potentially introduces additional risk around, ownership changes in suppliers or foreign influenced entities, et cetera. So unclear where some of this is going to go. We're, again, still waiting guidance, and our understanding is that these are the ratios that the material assistance will apply to, but again, that we still are awaiting guidance. So just to kind of set the stage for some questions, a lot of the investment in some of these technologies that we've seen a lot of deployment in, like solar and wind and storage, has really come mostly from corporates, right, who have greenhouse gas emission reduction goals associated with how greenhouse, scope 1, 2, and 3, who have looked for RECs, or, potentially initially this was largely driven by RPS standards. That is potentially changing. And especially when you're thinking about the availability of these tax credits, and when you're thinking about potential changes to how greenhouse gas emissions, some of those measurements, particularly around scope 2, are changing. So that some of the incentive to actually get into some of these PPAs for known technologies is potentially changing. There's this FEOC impact on all technologies, not just solar and wind. And then, as we'll talk about in the panel, lots of market design changes. What happens after July of 2026? Are we going to start to see new technology investments? What will it take to actually see some of those technologies go live? We'll talk about how venture capital plays into that. But then, how do you get into some kind of a long-term PPA with some of these unknown type technologies? Where, how do we think about some of the risk associated with the deployment of those technologies? And then, just general regulatory risk that is definitely increasing. So I'll leave it there just to kind of kick off the conversation. Thanks.
Great, wonderful. Thank you very much, Kelly. So Jacob, we're going to ask you to talk for a couple minutes about how do we think about market design and all these risk factors and the various pieces that all coming together. So go for it.
Thanks, Abe. Thanks you all for being here. So I thought what I would do is talk a little bit about New York and the kind of the state of play in New York. So in New York, we have the Climate Leadership and Community Protection Act, which sets a target of 70% renewable electricity by 2030, 100% clean electricity by 2040. And I think everybody recognizes at this point that at least the 2030 target is out of the picture. But there's a lot of questions about what to do about that. So as it stands now, we have about 25% of our electricity comes from hydro, 3 or 4% from wind, 5% from solar. We have a new line coming from Quebec. We have a couple offshore wind plants under construction. So we could probably get to about 50% by 2030 based on our current level of demand. Of course, we also have moved to electrifying heat, moved to electrifying vehicles. So we're bringing up the denominator. And so our percentage is looking like it'll be under 50. So I think it's worth thinking about first off, how we got to 50%, but then also why we're so short of 70%, given that we have this pretty strong policy goal. So in New York, we run auctions. We have been running auctions for a long time, but the current version of it for onshore wind and solar started in 2017, where we have a contract for differences that covers the energy capacity and REC, renewable energy credit revenue for wind and solar projects. So we basically lock in a price. Obviously, the details matter with basis risk, et cetera. But the idea is we're de-risking the revenue for the wind and solar plants, and that's supporting their financing and allowing them to be constructed. The major issue is that if you look at that program starting in 2017, the attrition rate is pretty remarkable. So last I checked, it was about 80% of the megawatts that had been awarded contracts had been canceled. A few more may have been canceled since then, since I checked, but it's in any event, it's a really high number ended up canceling despite having locked in that revenue certainty. So it goes to show that the details really do matter. Big part of the story is inflation and the cost, increased cost of the projects relative to what they expected at the time they signed. They put in those bids into the auction. So we have a lot of attrition in terms of onshore wind and solar. Big story there is the supply chain and inflation, but there's also issues with land use and siting and workforce and things like that mixed in. Then we have another big chunk missing from offshore wind. So another component of our plan is to have 9 gigawatts of offshore wind. We do have one wind farm offshore operational and 2 under construction. That'll get us to, I think, around 2 gigawatts. But starting in January 2025, the plans for any subsequent offshore wind were put on hold. And so there's no realistic way we'll start any before through the Trump administration. So those are at least on hold until 2029. So there's another big gap there, which speaks to the policy risk or the regulatory risk that Kelly mentioned. If we have the swinging back and forth between an administration that was really trying to push offshore wind to an administration that it wants to completely stop it, that obviously makes things difficult for infrastructure development. Okay, so we're behind our target. So we're maybe at 50% before we add in the heat and vehicle electrification. So what else has been going on? In 2023, we passed the Build Public Renewables Act. So what this bill does is allows the New York Power Authority, which previously had not been in the business of building generation, to now participate in that in that part. So it's kind of unbundling in a sense, and allowing NYPA, which is a transmission owner, to now develop some generation projects. So the theory there is, okay, so if the auctions from NYSERDA, which de-risks the revenue, was not enough, we can go to public ownership, and this way we'll de-risk also the cost side and shift more of the risk onto the ratepayers, and maybe that will make shrink that attrition rate. So instead of having 80%, we'll be able to push some of those projects through. NYPA is starting to partner with independent developers and propose some projects of its own. We'll see what effect that has. Another change is that Governor Hochul last July directed NYPA to develop plans for a new nuclear project. So everything I've talked about so far is about the 70% by 2030 goal, but we also have this 100% by 2040 goal. As NISO has shown and numerous modelers have shown, you can't do that with wind, solar, and storage alone, at least not cost effectively. And so Governor Hochul and NYSERDA and et al. Are thinking about, okay, what do we do to get the clean, firm resources into the system to support the 2040 target, and nuclear is back on the table in New York. So I think this raises some more really interesting, challenging financing questions. Obviously, our most recent experience in the U.S. At Vogtle was that nuclear is both incredibly expensive and comes with a significant amount of overrun risk. So there's questions about if we were to. So that comes with a question of, okay, as Kelli was talking about, who wears that risk? Is the state of New York willing to do that? Where we have shown that we're willing to pay a lot for power, but where I'm not sure that we've shown that we're willing to wear that level of risk. The other thing that is going on is, given all the challenges we're having, you're starting to get rumblings of, okay, should we soften those 2030 targets or those 2040 targets? After the One Big Beautiful Bill, the cost of RECs is going to go way up. The cost of executing on these policy objectives is going to go up for New York. Furthermore, we had underestimated the cost to begin with, and so it's probably going to be more expensive than we had originally anticipated. So should that cause us to revisit the targets themselves? So this introduces another flavor of policy risk, I think, because from a project developer standpoint, the revenues, particularly for something like nuclear, is contingent on the policy being in place. Meanwhile, for the owners of the existing gas assets, which we're still relying on in the system, the continued viability of those plants in some sense relies on the state giving up on the policy targets. And so their incentives to invest in the ongoing operations of those plants is also subject to policy risk. And so right now we find ourselves in I think a pretty difficult situation. So with that positive note, I'll hand it over.
Yeah, right there. Yeah, so Bryan, that was a sobering look into the future. So why don't you give us your perspective, which I think is probably quite different.
Yeah, a little different, but maybe I'll start with an introduction. Excuse me. So my name is Bryan Long. I work for JP Morgan. I sit on our power trading desk in New York City. Background, I came up through a gen desk and traded real time, day ahead. I worked my way into forward term trading positions. I spent 10 years trading power markets and then worked with ABIT NRG, where I was hired to work on structured origination. So very focused on looking for wholesale power hedges to have revenue certainty for the generation fleet. And, based on sort of what that revenue profile looks like, there's a whole different class of investors that are attracted to come in to support the business that all have different requirements around the rates of returns that they're looking for. About 5 years ago, the sort of expanding opportunity set in the power space created sort of a swelling of interest from banks in New York. So now I sit in this seat that's sort of an intersection between our banking team, our commodities team, and the other sort of infrastructure financing, credit risk, credit doc negotiations, legal controls. And I originate and then integrate all of the sort of review and approvals for like the larger transactions that are available out there. So I primarily look at gen hedging, I primarily look at load hedging, and then all of the different risks and parameters that are around those kinds of transactions. So the markets that Jacob is designing is something that we're involved in trading and having to manage positions around. And then also the design of these auctions and the other the other sort of longer term supporting mechanisms that are out there is something that is weighed in the transactions that we're entering into. A lot of the interest on our side is around organizing that capital stack that Kelli talked about, where based on the quality of the transaction, the characteristics of the transactions, you're going to have different set of investors that are going to want to get involved and participate in that particular opportunity. You're going to talk quite a bit that probably. But basically, people don't need to invest in power infrastructure. Like, you can leave your money in the bond market and get 4%. You can invest, in other avenues that maybe have less risk and make more sense and are less complicated. And so, we're in this paradigm where the power markets need to be attractive to attract investment capital from all different classes of investors. So you have the most conservative investors that are sort of your pension funds and infrastructure, global infrastructure portfolios and other sovereign wealth interests that are looking for stable long-term returns, all the way up to more speculative sources of capital that are backed by private equity, hedge funds, venture capital firms, and want a larger rate of return as a result of that. So when we have markets that are in turmoil or when we have markets that have uncertainty, there's a certain investor class that will just step aside and choose not to participate and allocate their capital to it. That's the cheapest capital that's available, meaning that would also be the lowest cost solution for consumers and for the marketplace in general. When those investors step aside because of uncertainty, the other investors that are available are going to want a larger rate of return for the risk that they're having to absorb. And there's a whole slide dedicated to the risks. As a result, that's going to end up costing more at the end of the day. And it's going to also be harder to organize the individual investor components that will come together. So what you'll see is very large, stable transactions have an ability to be digested by one source of private capital. When you end up in something that's more complicated and has more risk, you'll have to bifurcate your capital sources, and there will be multiple counterparties that come in for smaller allotments in order to make sure that you're able to reach that sort of critical mass and viability of the transaction. So it's kind of one of those things where I've never been to a technical conference before. Thank you for the invitation, Abe. It's fascinating because I know there's a lot of focus on this sort of pure markets efficiency for real-time, day ahead, and sort of the shorter term planning for resilience and reliability that's incredibly important. There's also this other component that's looking for longer term stability and longer term confidence in terms of how the rules, the regulations, the requirements are going to be organized. I think that there's the possibility that we could create stable power markets for the future, given the size of the load that's coming. I mean, we're talking about conservative load estimates that are still very significant in terms of what that means. And it's one of those approaches where you want to have the ability to reflect stability to the marketplace, to attract more stable investment capital, and to be able to minimize the cost as you're able to navigate into the future that we're headed towards. That's my introduction. Looking forward to the discussion.
Hi, I'm Lou Schick. I'm going to do a little background and I think say a couple of controversial things just to nudge us along. I can't help myself anyway, so I'm just warning you. I'm a physicist by training. I quit my PhD program and I taught high school for 5 years. And I'm so sort of misguided that I was trying to advocate to my high school students that we should change the subdivision laws in New York State so that if you were going to carve up farmland, you should insist that district heating be put in because that's, rational. Right. So wrong audience, wasn't going to win the argument. I end up being encouraged to spend more time with my family by my high school principal. I got fired. I worked, I went to work for General Electric. I worked in the main plant doing gas turbine product service, and I learned an enormous amount about how the industry actually works. So while I was busy being the product service support for 1,500 E-class gas turbines, not by myself, but we had a lot of them. The F-class was busy wrecking, and we were having this crisis where GE was in danger, like GE Power Systems for sure, but GE Corporate entirely. We had bet the business on this, and it wasn't working, and we couldn't get insurance. And you can't build without insurance. So when you start making a list of preconditions for getting something into the ground, if GE can't get insurance, good luck. That's a startup. Did a bunch of things at GE, including looking at disruptive technologies in energy and figuring out where we could play and where we couldn't play. And I ran GE solid oxide fuel cell program. So I did a whole bunch of looking at kind of comparative economics of generation technologies and timescales and risks. I told GE that it wouldn't work. And my boss was really pissed at me. So I got sent to the countryside for re-education, where I was in charge of evaluating the cost of hydrogen and the cost of nuclear for GE. And I had inside information on all those things. When I left GE, I worked at a startup, lived through startup world, and then I've been an investor very early stage in a hedge fund, which had no business doing it. I did private equity and project finance, which I'm going to share an anecdote about. And now I'm currently at Clean Energy Ventures, and I'm going to give my my sales pitch very briefly for Clean Energy Ventures. We are a venture fund that invests in technologies with the potential to avert multiple gigatons of CO2 equivalent GHGs in the next 30 years. We are aware that this is somewhere between ambitious and unreasonable. When you start talking about risk, venture is on the kind of extreme risk side. There are many investors who just think that's a dumb asset class, and they're not necessarily wrong. I mean, I still have to prove I can do what I'm trying to do. So the anecdote, once upon a time, we got the opportunity to repower a wood burning boiler in Michigan. So it was a 40-year-old machine. We were working with a 100-year-old boiler company for an upgrade. We're talking about buying a couple of blowers. We were collecting waste wood in the Upper Peninsula, and we had huge amounts of buy-in from the community, at all levels. So you've got your local humans, your local government, your state government, your county government, your federal. You need all of them to give you a bear hug and say, we love you. And we were trying to raise debt for this. And I spent probably a full person month trying to figure out if I could generate capital that I could reliably get enough waste wood out of the Upper Peninsula in Michigan, which, by the way, if you've been there, there's wood. So when you start thinking about the process of getting something financed, and by the way, we were looking for 20% money, and real projects should be at 5 to 8% money. So they were already doing kind of high risk money, and they were still getting really pissy about, are you sure you can get the wood? So when you start thinking about doing something like building a nuclear plant, and the track record is that they overrun by a factor of 3 in cost and they're late by 5 years, and then you throw in the fact that there's random price spikes in steel based on some whim out of the White House, and there is no supply chain. The vendors who have end stamps that are allowed to make parts do not exist in the United States. Oh, and you're not allowed to import stuff anymore. Right. I mean, it turns out for a full scale reactor, I don't know if this has changed, but it used to be that there was one forge in Japan owned by Japan Forge. that was big enough to make a reactor vessel, right? So if you start putting together, what are all the ways that you might miss your budget on the one hand, and on the other hand, you're trying to talk to a banker who's basically saying, there's a loan to value, but there's 15 other covenants. There's a debt service coverage ratio. There's a reserve in case, and then you make a list of shit you're worried about that might happen. And all of a sudden it turns out that your 7% capital may be costing you 15% of the total cost of the project in just escrow accounts, and that's fine if you build it on time. And the cash flow waterfall, which this is a phrase you should learn. Cash flow waterfall basically means who gets paid when. And so because the United States has a sort of a Reagan disease where we decided you can't give grants for things, we do everything with tax policy. And this is a way of winning rich people, right? So the whole concept of tax equity, the folklore, by the way, was that was invented by a private letter from GE. I don't know if that's true. Other people have claimed responsibility for it. But the gist of it was essentially, I'm building something new. I don't have profits. How can I take advantage of taxes? Ooh, I made a friend with a rich person who wants to hide their money from taxes. And GE wrote a letter basically saying we should let them work together. It's like peanut butter and chocolate together at last. And I've also been invested in a company that, went nearly belly up 3 times because the wind direction changed and tax equity wasn't available, right? We had this perfectly good business. Everything was profitable, but someone got skittish to the point that Bryan made, like someone who has a right to get skittish. It's not my money. And they didn't want to invest in tax equity that year. Well, I can't hold my breath for a year. So when you start thinking about what we're trying to do here, I want you to keep in mind, there's probably 10 more stakeholders that can kill a project than you even know how to list. The cost uncertainties are always hard, but in this environment, I am stumped. And there's an expectation from the lenders that they're supposed to, do their fiduciary duty and not loan out money they're not going to get back. Layer on top of that the fact that more than half the credit market is now no longer bank credit. It's all private credit because people wanted to get out from under the regulations. But that doesn't make it more transparent or predictable. Getting these things done where you can get all of these stakeholders aligned in their interests and agreeing on what the terms are is incredibly hard. And the cartoon version that Kelli showed is there was no need to get more complicated, but most of the capital stacks that I've worked with had 3 or 4 different colors of debt. Okay, so it wasn't just, so we would have mezzanine debt, we would have ag loan debt, we would have bank debt. They would sometimes go back and forth on when they'd get paid in the waterfall. So if you're the sponsor equity, the likelihood that you're just going to get wiped out is incredibly high. So a rational person may not want to be the sponsor equity, right? They're the people who get paid last in the cash flow waterfall. One more thing about this is there are timescale mismatches, right? The idea of getting a straight line right of way permitted and built, the wire that is being plunked into the Hudson right now has been talked about for 15 years. It apparently is not going to come into my town, though they approached my town saying that it was going to come out of the river into my town. And then they got kind of an unwarm welcome and they never talked to us again. Okay. Brilliant, by the way, state behavior. But these timescales are 10, 15 years. It took 12 years to get the 600 megawatt line from PJM to New York City. And at the last second, NYPA, who's now been put in charge of the policy goodness here, extorted, and I use the word quite deliberately, right before the thing went commercial, they demanded another payment or they wouldn't allow it to land in New York City. The hardware was in the water. This was a state entity. Okay. Well, state entities committing extortion, I guess, is not as rare as it used to be. So as a finance player, things that take 10 years and an unpredictability, these are risks that bankers should appropriately say no to. And if it's not bank debt, it's more expensive. So when we're thinking about how we want to do these things, here's the controversial thing. A nuclear plant, and I'm going to make a categorical statement, and I'm going to support it with some anecdata, and then please email me when you show me evidence that I'm wrong, because I should know. No nuclear plant's ever been built as a commercial enterprise. There are commercial participants. There are vendors. There may be someone who takes some of the debt. But in the United States, the catastrophe insurer of last resort, I don't know where the cap is this week, but it's $3, $4, $5 billion. It turns out if you nuke a city, that's expensive. And so no one would build nuclear reactors unless basically the government said, we'll take on the catastrophe risk. One of the reasons we couldn't build nuclear reactors in India is when George W. Bush said we were going to do it, the Indian government said, we saw what you did in Bhopal, we're not taking your risks. Okay, they just changed, Modi just notionally changed the law because he can do things like that. But so the first thing to keep in mind is getting insurance for a nuke has always been a state enterprise. Getting permitting for it, getting approval for it, approving the vendors for it. And then if you look, the US built 100 nuclear reactors, and then we had 3 Mile Island. And the reactors used to be going down in cost. There was some evidence of learning. It was still not economic. And then we had 3 Mile Island, and all of a sudden the cost skyrocketed. And nobody's actually resolved the issue that it's the same technology. It was mismanaged. I'm a physicist. You can build a safe nuclear reactor. I'm not at all concerned about that, but you can't finance one. So the argument that I would make is that right now we've got major parts of our plan for modernizing the grid that require, at least unless some new precedent appears, that require state action, that are non-market choices. Large transmission lines that are high voltage, nuclear power plants cannot be built with market forces. They cannot be underwritten. They cannot be paid for. And so you can decide to do it. France did it, right? China's doing it. Russia's doing it. Wait, I'm listing countries, not companies. So just keep in mind, markets don't solve all problems. Markets are great at interpolating with a well-posed set of rules that are static enough that you can actually run your spreadsheet. And if you break those rules, markets can't help you.
That is definitely a hot take on nuclear. But I want to bring it, sort of get to this question of what are price signals that the markets are sending us actually driving? Are they actually driving the kind of investment we need? And I think that sort of time frame issue is a really interesting one. Obviously, nuclear is in a much longer forward time frame than a combined cycle or a battery or energy storage. You've all sort of talked about this in various ways, but what do you see coming out of these markets? And are the price signals that are getting sent right now, are they driving the investment? Are they making the capital comfortable based on the market revenues that they can go out and invest in either something like a combined cycle or a battery storage system or ultimately nuclear? And if not, then how do we think about that?
So I'll start from the perspective of thinking about, solar and wind projects, and I would say no. They're mostly financed through these PPAs that are relatively out of market. And as I said, it's mostly driven by what corporates were wanting to do. So that, and, we can talk about this too, but in those contracts that I mentioned in the PPAs, sometimes there's an element where they are eligible to sell the capacity, but it doesn't, the contract doesn't include the capacity payment other than, the structure that New York is putting in place. It's fine if they want to participate in the capacity market. We are not considering that as something that we need in order to get paid back. We also, if we say, yes, this asset is going to participate, all we would do is add the risk of, a non-performance or whatever, and not, the actual revenue from that. So from the perspective of the types of resources that we're mostly seeing come on the grid, I would say, no, it's not really about market prices. For new stuff, also probably not really about market prices, because underwriting and, depending on, where your capital is coming from, if you want it to be really expensive capital, I mean, maybe they'd be willing to take all kinds of risks. But if you want it to be the cheap kind of capital that can lower the cost of deploying those technologies, you have to have a lot more certainty than we have today.
So I read a book that my child encouraged me to read, and I'm forgetting something like "Stumbling Towards Utopia." I don't remember. I got the title wrong, but it's wonderful. But one of the quotes that "Slouching Towards," yeah. So one of the quotes that I really liked is, "Markets are really good at providing what rich people want." That's, I think one of the reasons my child gave it to me is that's how I talk. So I love that. If you look at what's going on right now, we have an investment in a thermal storage technology, and I won't try and sell you all my companies, I promise. But later, come find me. But we met a company, not my company, called Rondo, and Rondo made the following pitch to us. They basically said, look, the interconnect queue in California is 7 years long. They're outlawing natural gas. Middle-sized companies have no freaking idea what they're going to do. And we see an opportunity to partner with someone like NextEra to build a giant solar farm and have it captive and have it, heat up brick and be able to provide essentially baseload heat to an industrial customer and secede from the utility market. Okay. And if you look around, that's actually what's happening. The markets are speaking. The market signals are clear. The interconnect queue is so long, I have no idea what's going to happen. The backlog for ordering a gas turbine is so long, I have no idea what's going to happen. I think that there is a certain amount of magical thinking with nuclear. We can take that out of the list and just discuss other technologies. What the market is buying is utility scale solar plus batteries with a PPA, with a creditworthy counterparty, as long as there's not a utility that's going to get in the way. And the market signal is working. And if you can look, even despite all sorts of bizarre comments from various governments, gigawatts of the stuff are going into the ground and they're making money. Well, what are we using? We're using incredibly dull technology. We're using 40-year-old, 50-year-old solar. I mean, it's more modern than that, but it's pretty. I'm a gas turbine guy. Solar's easier. And the batteries are, relatively boring. Even if you screw up, CATL can just mail you new batteries if you need, and they're modular. So that's what you're going to get. If you don't change things, what you're going to get is people are going to abandon the grid and they're going to make their own power. And if you were worried that there was a death spiral before for the utilities, brace yourself.
I was just going to add a little bit to that. So, when you think about the deployment of new technologies, a lot of the technology risk, a lot of the focus is on de-risking investment in that technology through the deployment of pilot plants. To actually get something to scale is I think requires something a little bit different. So to scale means you actually have to have, the associated infrastructure that enables that. So for nukes, for example, figuring out how to deal with storage of spent fuel rods, with other technologies, potentially geothermal or carbon sequestration, you have to have pipelines. So we tend to think about de-risking investment in technologies just through the deployment of pilot plants, and that demonstrates, okay, this technology can work. But to actually scale it requires something different, and that also comes outside of markets.
Yeah, well, Jacob and Bryan, let's get you guys in this because I know, Bryan, you specialize in origination based on, market signals. And it was really striking to hear from both Lou and Kelli. I don't think they mentioned capacity markets other than negatively. I don't think they talked about LMP markets at all when they talk about driving this. So but you're looking at those things every day, right?
So the answer is no. The forward energy curves don't support building resources. And the difficult part about the capacity market is it was supposed to be a 3-year forward auction. It hasn't been a 3-year forward auction for a very long time. It's now months ahead of auction. So it's not sending the right sort of price signaling to the investment community of where to allocate capital for resource development and expansion. The forward curves in general don't support building of new gas peakers, CCGTs, batteries. It's all very complicated, as we know, because of all the risks and the other sort of costs involved. But it's a scenario where you're seeing very limited amount of development activity in PJM in particular. I think the Homer City redevelopment is sort of the current textbook example where it's a joint venture between 4 different, incredibly stout and knowledgeable companies. You're seeing the Texas Energy Fund in ERCOT that's having to subsidize the building of a new peaker fleet. You're seeing midterm resource adequacy contracts in California that have brought in 13 gigs of batteries. And so it's like there's these other sort of non-market factors that are creating the opportunities that are available now. The reality, though, is the amount of load growth that's coming, you're going to need to have more market solutions available to be able to have that capital deployed to build the infrastructure that's needed for that. And it's one of those things where to do that, your energy prices on a forward basis are either going to have to come up, or you're going to have capacity markets that are evolving to be able to support the revenue requirements for that, or other sort of regulatory mechanisms that would lead to much different implications for the future of the energy markets in the industry.
If on something that you said. So Massachusetts was playing around with the fact that you can't build a car charger and make any money at it. It's not, the cost benefit doesn't work for a variety of reasons. And the main reason actually is that the cost of the charger and the cost of the electrons is a small fraction of the total cost. The real cost is the grid drop that can support multi-megawatt charging. And so they started a program where they tried to get a mandate through the public utilities regulation to do a make-ready program. There was supposed to be a certain number of sites. There was going to be some mechanism for choosing good ones. And then the utility was supposed to do make-ready, and then private businesses could bid in. And I think that this is strictly analogous at a small enough scale where you can do it without having, to move heaven and earth to do it. That's fine that you're separating CO2, but where's your pipeline? Or that's fine that you put in a nuke, but where's your transmission line? But the idea there is, if you take some of the inherently non-market monopolistic government things and you admit that that's what they are, you can get markets to fill in the gap after the make ready.
Yeah.
Yeah, so I can respond a little bit to your question and Brian's comments. So Bryan mentioned we have this kind of mystery where everybody's talking about load growth and how it's out of control and how we're not going to be able to keep up. And then you look at the forward curves and there's kind of very little to indicate that we're going to have an increase in prices. I think if you look at the options available to me as a retail customer in the state of New York, it's a slightly different story. I have retail prices going up for the supply portion of my supply. But there's this mystery where we're expecting all this load growth. We know that we can't build enough supply to keep up, and yet the prices don't seem to be moving. I think there's kind of three theories. Theory number one is that the load growth isn't real. So the data centers is hype and they aren't going to be built to the scale that they claim. Theory number two is there's so much political interference, particularly in PJM, that it's difficult to contract around the future with the knowledge that there might just be political intervention or something like that that's going to clamp down on the price and not allow the prices to do what the market would say.
Just a small plug for the insanity there, right? But it's like, if I did a contract with somebody in Pennsylvania that was our, PJM based contractual provisions, and then Pennsylvania leaves the RTO, threats that have been publicly put out there, that creates an enormous amount of uncertainty, right? Like, how am I going to do a contract in Pennsylvania with this risk that they leave the market structure? It's nonsensical almost. It's crazy.
So then I think theory number three, which is something we've talked about for many years, is the idea that we have all the sellers in the market who really are interested in getting longer term contracts, but there's no in many states, there's not really an identifiable buyer for long-term contracts. And so there's this asymmetry on the market where there's a lot more interest in hedging from the supply side than there is from the demand side. And so particularly further out, there's not a lot of information value in the prices that the farther out in the forward curve you get. So I'll just add those 3 points.
I just wanted to add to your point, nobody is looking at the LMP. That's not accurate. So, you know, particularly in the PPA contracts that I mentioned, right? The reason that they're settling at a hub is because there's a price at that hub, right? So that's how we understand some of the revenue risk. That's where we understand, you know, what the basis risk is and what that differential between what the contract says they're getting paid and then what they actually might end up getting paid. You know, that's where we're trying to understand instances of negative pricing and how that might impact the price that's in the PPA versus what they actually get paid. So we are using that and it is helpful. That is how these contracts are working, especially when you have the virtual component. So just wanted to make sure that was clear.
Go ahead, go ahead.